Welcome to the deep dive. We're here to cut through the noise and get you the insights that matter. Today, we're looking at something pretty vital, but often, behind the scenes in the auto industry, the component manufacturers, especially in a place like India, where things are really buzzing.
Yeah, and our focus is squarely on Belrise Industries. They're a really significant player in India's auto component scene, and they're leaders in metal parts for two-wheelers. And just so you know where we're getting this from, our deep dive today is based entirely on a very fresh equity research report. It's from Jefferies, dated July 7th, 2025. They just started covering Belrise. So our mission really is to unpack the core stuff from this report. We want to explore what makes Belrise stand out, look at their growth drivers, there are quite a few, their strategies, financials, even sustainability. We're aiming to find those surprising bits, the key takeaways, without drowning you in data. Okay, so let's start at the beginning then. Who exactly is Belrise Industries? What's their sort of footprint in the auto world?
Right. So think of them as maybe a quiet giant working behind the scenes in India's huge motorcycle and scooter industry. Belrise started back in 1996, so they've been around the block. They're definitely one of India's top manufacturers for metal components for two-wheelers. We're talking chassis, exhaust systems, the real core stuff.
And they have a significant market share.
Oh yeah, a substantial share, around 24% in those key product areas. That's pretty dominant for those specific parts.
A quarter of the market. Wow. And revenue-wise, how does that break down for them?
Okay, so looking at their numbers for fiscal year 25. The biggest chunk, about 67%, that's from two-wheeler components. Makes sense, right?
Yeah, given their market share there.
Exactly. Then you get about 9% coming from four-wheeler components, smaller, but definitely growing for them. And here's something a bit different, maybe unexpected for an auto parts firm. Around 20% of their revenue actually comes from commodity trading.
Commodity trading, like what?
Yeah, things like metals, but also lithium-ion batteries, even electronics. So it's an interesting diversification.
That is interesting. We should probably circle back to that. But first, their track record. The report mentions pretty impressive growth, right? Like 15 to 17% CAGR.
Yeah, absolutely. Between fiscal 17 and 25, they delivered compound annual growth rates of, 15 to 17% across the board, revenue, EBITDA, net profit. Solid performance.
Okay, but growth is one thing. How does that compare to the overall market they operate in?
Ah, that's the crucial context. You see, over that same period, the entire Indian two-wheeler industry, its volume CAGR was just 2%. Barely moving, relatively speaking.
Only 2%. Wow.
Yeah. So Belrise growing at 15, 17% while the market's doing 2%, that tells you something important. They're not just riding a wave, they're actively gaining share or, adding value in ways that let them massively outperform.
That's a huge differentiator then. Their growth isn't just tied to the market expanding.
Exactly. It points to a really strong business model, maybe innovation, maybe operational efficiency. Likely a mix. They can grow even when the underlying market is slow. That shows resilience.
Got it. So digging into their products a bit more, what are they really specialized in?
Their absolute core is sheet metal pressing and fabrication. That accounts for something like 90% of their manufacturing revenues.
So things like
I think structural parts, chassis, obviously, exhaust systems, and also body and white parts.
body in white, remind us.
Yeah, that's basically the vehicle's metal shell, right? The assembled sheet metal structure before they add paint, engine, interiors, all that. But they also do other things like polymer parts, some suspension components, steering columns too.
And you mentioned future-proofing. How does that play out in their product mix?
Right. A really key point from the report is that 73% of their manufacturing revenue is powertrain agnostic.
Meaning it doesn't matter if it's a petrol engine or an electric motor.
Precisely. It's not tied just to internal combustion engines or ICE,
Oh,
which is smart given the EV shift. In fact, EV sales already made up about 4% of their manufacturing revenue in FY25. And they're actively planning to grow that, including developing their own hub motors for EVs.
so they're hedging their bets, basically. Makes sense. Now, they operate quite a few plants, right? 17 facilities across 9 states.
Yeah, it's a big operational footprint. They're located strategically in the main auto hubs across India.
With that scale, is their customer base diverse or is there concentration risk?
That's a really good question, and something Jefferies highlights. There is significant customer concentration. Their top 3 customers, plus the vendors in their ecosystems, account for about 67% of manufacturing revenue.
2/3 from just 3 main relationships.
Yeah. And Jefferies believes Bajaj is likely the biggest one. Now, this isn't uncommon in auto components. You often have deep ties with a few OEMs. but it's definitely a factor you need to be aware of, a risk factor potentially.
Okay, so we have a good picture of Belrise now. Solid foundation, strong historical performance, but some customer concentration. Let's look forward. The Jefferies report points to some big growth drivers.
Yeah, this is where the story gets really interesting, the forward-looking part.
Which drivers do you think are the most, well, compelling? And maybe are there any potential bumps in the road with those?
Right, so Jefferies lays out several key tailwinds, but fundamentally, the rebound in the Indian two-wheeler market itself seems absolutely core to their thesis. We all remember that rough patch, FY19 to FY22. 2W wholesales just plummeted, down 35%. A combination of factors, right? New regulations, cost hikes, economy, COVID.
Yeah, it was a perfect storm for that sector.
It really was. But the good news is we've seen a strong recovery since then. Wholesales grew at a 13% CAGR between FY22 and FY25.
Okay, so bouncing back nicely.
Bouncing back, yes, although FY25 sales were actually still about 6% below the peak levels of FY19, so still some ground to recover. But looking ahead, Jefferies is actually quite bullish. They're forecasting a 10% CAGR for the domestic 2W industry, and even stronger, 13% for export volumes from FY25 to FY28.
Which averages out to?
An 11% overall production CAGR for India's two-wheeler sector.
Yeah.
That's a healthy underlying market growth for Belrise to tap into.
And what's driving that optimism? Are there specific factors?
Yeah, Jefferies points to a few things. Potential income tax cuts, maybe easier liquidity conditions. There are PSU wage hikes expected in FY27.
Ah, putting more money in people's pockets.
Exactly. And there's even talk, a possibility, of a GST rate cut, specifically for two-wheelers. Any of those, or especially a combination, could really juice demand.
Okay, so a recovering market is one big driver. Another strategy Jefferies highlights is increasing content per vehicle, or CPV. Explain that a bit.
Sure. CPV is basically just the total value of the parts Belrise supplies for each single vehicle, each bike or scooter.
Right, more value per bike.
Exactly. Their current CPV for two-wheelers is around 12,500 rupees.
Yeah.
But here's the ambition. Belrise wants to increase that by 38%, up to about 17,300 rupees.
That's a massive jump. 38% more value per vehicle. How on earth are they planning to do that?
It's ambitious, no doubt. It really signals a strategic shift. They're moving beyond just making parts to spec. They're building a portfolio of their own proprietary products.
Like what kinds of products?
Things like suspension systems, steering columns, filters, brakes, components where they own the design and potentially the IP. They've even, as we mentioned, started trial production of hub motors for EVs. That adds a whole new potential value stream.
So trying to sell more and higher value parts to each customer. Does the report suggest there's potential there even with existing clients?
Yes, and this is a really interesting insight from Jefferies. They point out that Belrise's content per vehicle with its second largest OEM customer is still about 30% lower than what they supply to their top customer.
Ah, so there's headroom, significant headroom, just to catch up with existing big customers.
Precisely. It suggests there's untapped potential just by deepening those relationships, becoming a more integral supplier to clients they already have.
Yeah.
It's not just about finding new customers.
And does that require more than just, a good sales pitch? Does it mean getting involved earlier in the design process?
Absolutely. That's the key. It's less about just selling parts and more about forging deeper R&D and engineering partnerships, becoming that indispensable partner who can supply more critical, higher value systems per vehicle.
It really sounds like they're trying to climb the value chain, and this is happening just as the Indian two-wheeler market itself is premiumizing, right? People buying more expensive bikes.
Exactly. That's another critical tailwind working in their favor. Jefferies gives a great example. The chassis. For a premium motorcycle, the value of the chassis might be around 5,500 rupees. For a basic commuter bike, it's maybe 2,500.
So more than double the value for the premium bike part.
Right, 2.2 times the value. And Jefferies expects demand to keep shifting towards these premium bikes and scooters. Especially as overall 2W penetration in India rises, it's still only around 55% of households. So lots of room to grow, and that growth seems tilted towards the higher end.
This all points towards a really interesting evolution in how they operate. So what does it mean for their actual role, their position within the whole auto ecosystem?
Yeah, this is where that strategic shift really crystallizes. They're consciously evolving, moving from being just a standard tier one supplier, someone who makes individual components to order.
To something more integrated.
Exactly. To becoming what Jefferies calls a tier 0.5 system integrator.
Tier 0.5, what does that mean in practice?
Think of it like this. Instead of just supplying, say, the metal tubes for a chassis, They're designing and delivering the entire chassis system, maybe comprising hundreds of unique components, all assembled and ready to go.
So they're taking on more responsibility, more complexity.
Yes, offering complete systems and subassemblies. This increases their value add significantly, and it makes them much more strategically important to the OEM. They become almost an extension of the OEM's own R&D and manufacturing.
That's a big leap. Can you give us any concrete examples of where they're actually doing this?
Sure. The report mentions Belrise is already supplying a complete two-wheeler chassis system. Think 200 to 250 unique parts on a single-source basis to one major OEM.
Single source. Wow. That's a lot of trust.
It is. And looking forward, they've apparently been chosen by a commercial vehicle OEM to co-develop and manufacture a complete chassis system for a new platform that will have both CNG and EV versions.
Code develop. So really involved from the start.
Right. Production for that is set to start in the second half of fiscal 26. That's not just making a part to a print. That's a deep, long-term engineering partnership. It's a different ballgame.
Okay, so two-wheelers are clearly the core, and they're moving up the value chain there. But where else is Belrise looking for growth? Are they diversifying beyond 2Ws?
They definitely are. A major focus is targeting the four-wheeler component market. And you have to remember, in India, the 4W component market is roughly 3 times the size of the 2W parts industry.
So a much bigger pond to fish in.
Exactly. Right now, only about 12% of Belrise's manufacturing revenue comes from four-wheelers. But they've set a pretty ambitious goal. They want to double their 4W revenues in just the next 2 to 3 years.
Double it. Okay. And how are they going about that? Just winning more contracts?
Partly, yes. They've already secured new orders from 5 passenger vehicle OEMs and 3 commercial vehicle OEMs. So they're making inroads with new customers. But it also ties back to that Tier 0.5 strategy. They're developing proprietary 4W products too, things like crossbeams, chassis systems for cars and trucks.
Applying the same system-level approach.
Right, and what's really telling, I think, is that they've even won an order to supply steering columns to a large European OEM. That's a significant win, showing their capabilities are being recognized internationally now, not just domestically.
That's a big validation, getting business from a European major. And speaking of international, exports are another area. They seem ambitious there too.
They are. Exports are currently pretty small for them, only about 6% of manufacturing revenue.
Room to grow then.
Lots of room. Their strategy is basically to leverage relationships they already have, maybe through existing customers who operate globally, like JLR in Europe, to get more direct export business with OEMs in Europe and America.
And is that working? Are they getting traction?
It seems so. The report says they've already secured orders from 2 European OEMs, with production planned to start in the second half of fiscal 26. So, concrete steps towards diversifying geographically and reducing dependence on the Indian market alone.
So strong organic growth plans. But acquisitions seem to be a key part of the strategy too, right? Jefferies mentions a couple of recent ones.
Yes, acquisitions were definitely playing a role. The big one was H1 India, which they acquired in March 2025 for about 1.9 billion rupees.
H1 India, what did that bring to Belris?
This looks like a really smart strategic buy. H1 brought crucial expertise in manufacturing using high-tensile steel.
Which is important because
High-tensile steel is key for lightweighting vehicles, making them lighter, which helps with fuel efficiency or battery range, and often cost efficiency too. It's a big trend across the industry. This acquisition alone is expected to boost their potential four-wheeler content per vehicle by a massive 50 to 60%. That's roughly another 15,000 rupees worth of potential parts per car.
wow, huge CPV impact. Any other benefits?
Yes, it also crucially opened the door to relationships with 2 Japanese four-wheeler OEMs, customers they might not have had access to before.
And what's the plan for integrating H1? Just let it run.
No, they have a clear plan. H1 apparently had pretty low capacity utilization, so Belrise aims to ramp that up significantly and also bring H1's EBITDA margins up to match Belrise's existing manufacturing margins. So clear synergy and improvement targets.
Okay, that was H1. There was another smaller acquisition too, Mag Filters.
That's right, acquired in Q3 of fiscal 25 for about 165 million rupees. Much smaller deal.
And what did Mag Filters add?
It added a completely new product line for them.
Yeah.
Filtration systems, think oil filters, air filters, that kind of thing. In terms of CPV, it adds about another 1,000 rupees, maybe 3% increase. Not huge, but it broadens their portfolio.
And the revenue potential.
Mag Filters is expected to generate maybe up to 1.25 billion rupees in revenue when it's fully utilized. That's about 1.5% of Belrise's total FY25 revenue. So it's incremental, but adds another string to their bow, another product category.
And all this expansion, organic acquisitions, needs manufacturing capacity. Are they building new plants as well?
Yes, they're investing heavily in new facilities to support this growth. They've got a plant already up and running in Chennai, in Tamil Nadu. That one's serving 2W and CV OEMs, and it's projected to hit nearly 2 billion rupees in revenue when fully ramped up.
Okay, one new plant operational. Any others coming?
Yep. There's another facility being built in Bhiwadi, Rajasthan. That's expected to start production around the second quarter of fiscal 26. It'll cater to two PV OEMs and two 2W OEMs based there. And there's also a smaller facility in Pune, Maharashtra. That one's interesting because it's specifically piloting the production of those hub motors for electric vehicles we talked about. Trial production has already started there.
So definitely putting the capital expenditure behind the growth strategy.
Clearly investing in the capacity needed for the future.
Yeah. All right, let's pivot a bit now and talk about the numbers, the financial picture. What does Jefferies actually predict for Belrise's financial performance going forward? And what about sustainability? ESG is so important now.
Okay, on the financials, looking out from FY25 to FY28, Jefferies projects a pretty healthy 12% compound annual growth rate for both revenue and EBITDA.
12% top line and EBITDA growth and margins.
They expect EBITDA margins to hold fairly stable, around 12.3%, which for a manufacturing-heavy business like this is quite respectable. But where the forecast gets really impressive is on the bottom line. They're projecting a 30% EBITDA for net profit over that FY25-28 period.
30% profit growth. How does that work if revenue and EBITDA are growing at 12%?
Great question. The big driver there is deleveraging. As they pay down debt, their interest costs fall significantly, which really boosts net profit growth beyond EBITDA growth. Plus, the underlying EBITDA growth is healthy too.
Makes sense. Less interest expense flows straight to the bottom line. What about earnings per share, EPS?
It's also strong. Jefferies forecasts an 18% CAGR for EPS over FY25-28. Now, that's slightly diluted in the first year, FY26, because of the new shares issued in their IPO.
Ah, the IPO impact?
Right. But if you look specifically at the period after that, from FY26 to FY28, the projected EPS CAGR is even stronger at 24%. And one other metric, return on capital employed, or ROCE pre-tax, that's expected to improve too. From around 13% in FY25 up to 15% by FY28, mainly as they utilize their capacity better. So they're becoming more efficient with their capital.
Okay, solid growth, improving profitability and efficiency. You mentioned deleveraging is key. How significant is that shift on the balance sheet?
It's actually a dramatic shift forecast by Jefferies. They expect Belrise to go from having about 28 billion rupees in net debt at the end of FY25
Okay, significant debt.
to having around 6 billion rupees in net cash on the books by the end of FY28.
Wow, from net debt to net cash in just 3 years. That's huge. How?
The main catalyst is the IPO. The report says about 22 billion rupees in proceeds from the initial public offering are enabling this massive deleveraging.
So using the IPO money primarily to clean up the balance sheet.
Exactly, which then frees up cash flow. They're expected to generate healthy free cash flow to equity, or FCFE, of around 3 to 6 billion rupees per year in fiscal 26 through 28.
And are they still investing? Or just
Yeah.
paying down debt?
No, they're still investing significantly in growth. The plan is to spend about 8 billion rupees in capex over the next 2 years to keep fueling that organic expansion we discussed. So it's a balance. Deleverage and invest for the future.
Got it. Now, we touched on that commodity trading business earlier. It's about 20% of revenue. What's the thinking there? Is it core?
It's an interesting one. It contributes about 20% of total revenue, but only around 6% to profit after tax, so lower margin than manufacturing.
Okay, so less profitable.
Right. It seems to be primarily concentrated in the Middle East and Asia Pacific. Jefferies expects it to grow, but more slowly, maybe a 5% CAGR over FY25-28. Why have it? Well, for companies dealing with volatile metal prices, sometimes a trading arm can help manage price risk, or perhaps provide sourcing advantages. Or maybe it's just a legacy business generating some extra cash flow. The report doesn't delve deeply into the synergy, but it's a notable part of the mix.
Okay. Now, something else Jefferies flags is related party transactions, or RPTs. This often raises eyebrows. What's the situation at Belrise?
Yeah, this is definitely an area investors watch closely. The report notes that in the first 9 months of FY25, related party sales were 26% of revenue, and related party purchases were 29%.
That seems quite high. What are these transactions typically for?
Mostly for outsourcing certain manufacturing processes, things like cutting, bending, drilling metal parts, to entities connected to the main Belrise group or its promoters.
Okay, so outsourcing work to related companies. Why does this matter?
Well, large RPTs, even if perfectly legitimate and at arm's length pricing, can sometimes create concerns about transparency, corporate governance, or whether profits are being potentially shifted around. Investors generally prefer simpler structures with fewer related dealings.
So what's Belrise doing about it? Are they addressing this?
Yes, and this is positive. The report states Belrise is actively looking to simplify its corporate structure and reduce these RPTs
Ow.
through various methods: mergers, acquisitions of those related entities, divestments, or just increasing outsourcing to independent third parties instead. As a concrete example, they have an agreement to acquire 100% of Bad Comps Private Limited, which the report identifies as the single largest related party for both sales and purchases.
Ah, so bringing the biggest one fully in-house.
Exactly.
Eh.
And they're also apparently evaluating merging other related entities into the main listed company as well. The goal seems to be cleanup and simplification.
And the implication is?
That this simplification, leading to greater transparency and potentially better governance perception, could actually provide a further boost to Belrise's valuation multiple down the line, removing an overhang, essentially.
Makes sense. Investors appreciate that kind of cleanup. Okay, moving beyond financials and structure. ESG, environmental, social, governance. How is Belrise tackling this? Especially for a manufacturing company.
Right, ESG is crucial. For auto component firms like Belrise, Jefferies identifies the key issues. Things like emissions from manufacturing, product safety, obviously, labor practices and governance, how efficiently they use materials and handle recycling, and managing hazardous waste and water usage.
A pretty broad set of responsibilities. What's Belrise doing specifically?
The report mentions they aim to limit hazardous waste and pollutant discharge across their plants. They use effluent and sewage treatment plants, which is standard practice but important.
And on the environmental side, emissions.
They're working on minimizing emissions. One concrete example given is an agreement they have to source 200,000 kilowatt hours of electricity per month from a solar power plant, so moving towards renewable energy. What's also interesting is that the Jefferies report actually includes specific ESG questions they still have for Belrise management about detailed targets, how they maintain their green infrastructure.
So it's an ongoing dialogue, not just a snapshot.
Exactly. It shows Jefferies, and likely the investment community, is keeping a close eye on their progress and commitments in these areas. It's not just about the numbers anymore.
Okay, so we've covered a lot of ground: the business, the growth strategy, financials, ESG. After digging through all of this in the Jefferies report, what's the final verdict? What's the bottom line recommendation?
The bottom line from Jefferies is pretty clear. They initiated their coverage on Belrise Industries with a buy rating.
A buy. And did they put a price target on it?
Yes, they set a price target of 135 rupees per share. At the time the report was written, that represented about a 31% potential upside from the previous day's closing price of around 103 rupees.
31% upside. Okay. What's the thinking behind that? What's the valuation rationale?
Jefferies finds the valuation attractive. They specifically mention its price-to-earnings ratio, or PE. Belrise was trading at about 18 times its estimated earnings for fiscal year 2026.
18 times earnings. Is that high or low?
In the context of its growth prospects, Jefferies sees 18x as attractive. But the really compelling metric they highlight is the PEG ratio.
Right. Price earnings to growth. You mentioned that earlier. Explain how that works again.
Sure. The PEG ratio basically takes the PE ratio and divides it by the expected earnings growth rate. It tries to give you a sense of whether you're paying a fair price for the growth you're expecting. A PEG ratio below 1 is often considered potentially attractive or undervalued.
And where does Belrise stand on PEG?
This is where it stands out. On Jefferies' estimates, Belrise's PEG ratio comes out at 0.8x.
0.8, so below 1.
Well below 1. And crucially, Jefferies compares this to the average PEG for most other Indian auto part companies, which they peg at around 1.8x.
Wow, 0.8x versus 1.8x. That's a huge difference.
It really is. It strongly suggests that relative to its peers and its own expected earnings growth trajectory, Belrise looks significantly undervalued according to Jefferies' analysis. You're paying less for each unit of expected growth. They also make another interesting valuation point, that Belrise's enterprise value to EBITDA multiple was trading closer to basic steel companies.
Like commodity producers.
Yeah. And Jefferies thinks that comparison is just too harsh. Given Belrise's strategic positioning, its move to system integration, its growth potential, they see it as much more than just a metal basher.
Okay, so the valuation looks compelling based on growth, but no investment is without risk. What potential downsides or risks did Jefferies flag?
They did identify a few key risks to keep in mind. First, the obvious one, Demand for two-wheelers in India could be weaker than expected. That's fundamental.
Market risk.
Right. Second, that customer concentration we talked about. Their high dependence on their top customer, believed to be Bajaj, is a risk if anything negatively impacts that relationship.
Okay, customer risk? Anything else?
And third, the related party transactions. While Belrise is working to simplify things, any unforeseen negative development or scrutiny related to those RPTs could be an issue.
Market, customer, and governance structure risks. Got it. All right, so to quickly wrap up our deep dive today, we've seen Belrise Industries as a major player in India's auto component world, especially strong in two-wheelers. They've got a clear strategy for growth-boosting content per vehicle, becoming more of a system integrator, diversifying into four-wheelers and exports, helped by smart acquisitions.
And financially, the picture looks encouraging, with strong profit growth expected, driven significantly by deleveraging thanks to the IPO proceeds. The balance sheet is set to strengthen dramatically.
All leading to that buy rating from Jefferies, underpinned by what looks like a very attractive valuation, particularly that low PEG ratio compared to peers. Though you have to keep those risks in mind.
Absolutely. It's a fascinating story, really. You have this company with deep roots in traditional manufacturing,
Yeah, sheet metal pressing.
but it's actively strategically repositioning itself. Not just by making new types of products like for EVs, but by fundamentally changing how it serves its customers, moving from just being a parts supplier to becoming a true system partner.
That shift from tier 1 to tier 0.5.
Exactly. And maybe that leaves us with a final thought for you, the listener. What implications does this kind of strategic shift, becoming so integrated, almost indispensable to your customer, have for companies in other rapidly changing industries? How might businesses in different sectors adapt to become not just suppliers, but essential partners to their own customers in the future?